The most fascinating bit, looking at the last 5 recessions. The 1980 recession still had a 6.1% increase in real estate values that year.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Rod Cleef's Multifamily Boot Camp, happening May 1st through 3rd in Orlando, Florida. Go to rodsbootcamp.com and use the code RPOA to save $100. Hello and welcome to episode 219. Are we heading into another recession? If so, how will it affect housing and real estate prices? My guest today, Mike VanderWoude, doesn't have a crystal ball to answer that question. But what he does have is historical data from the past 5 recessions to help us understand what might happen. And you'll probably be as surprised as I was by his answers. And if you're wondering what effect the coronavirus is having on real estate so far, Mike also shares his on-the-ground perspective in a quick update at the end of this episode. Mike is an associate broker at Edison Brokers Co. in Grand Rapids, Michigan. He was also a guest on episode number 79, where we discussed his dilapidated and rundown 2-unit that he had purchased and renovated on the west side of Grand Rapids. It was right next door to a 4-unit that I owned. Since then, Mike has purchased my 4-unit, and he's going to let us know how it worked out. Mike, it's great to have you back in the studio.
Thanks for having me back. Glad to be here. It must have gone okay on episode 79.
It did. And, I've been wanting to get you back in the studio because ever since buying that 2-unit, and just to give people who don't remember that episode, it was basically I owned the 4-unit that was next door to it. This is on the west side of Grand Rapids. My rents on my 4-unit ranged from, I want to say 600 to 900 maybe, not even 900.
A little less than that. Yeah, 6 to somebody in there at 750 or 8, I believe.
Okay, thank you. Yeah.
So I've raised 3 of the 4.
Yeah, and you bought this 4-unit from me, but you had taken this 2-unit that was right next door and had been abandoned for like 20 years.
Boarded up for 11 years.
I mean, I used to watch birds fly in and out of the upstairs windows because there wasn't any glass in them.
We found dead animals and hypodermic needles in there.
Yeah, and you can go back to episode 79 and listen to our conversation about that. But you had really turned that around. You were getting up
$1,200 a unit.
$1,200 a unit.
And I could probably get more, but I get such a good type of tenant in there at that we like to keep them. And they tend to be of a millennial generation, which is moving less and less.
So ever since our conversation, the tenants are still there?
Let's see, some of the original tenants are there from 2017. At the point that I one day have to go back out to the market to get a new tenant, I'm probably going up on those rents.
Yeah, what would you go up to?
I'd probably try 1,300. It's still nicer than my house. We're talking 750 square foot 2-bedroom units, but they pretty much have everything but AC. Very modern furnishings, and they're fashionable. They're cool.
So has it been relatively simple from a management perspective? Because you do manage your own properties.
Yep. As you can imagine, relatively little maintenance on that one. Somebody managed to stop up a kitchen sink, and that put a little bit of water staining on the unit below. There was a sewer backup issue in the basement, which we had to resolve. That cost a few bucks, but probably if I'd been really proactive in the rehab, could have figured that out.
It's funny. It's always the pipes, isn't it?
Yeah.
I mean, the
stuff
problems you just
see.
Described are the pipes that are hidden and underground and whatever.
Yep.
Yeah. I wanted to talk about the 4-unit because I owned the 4-unit and sold it to you.
Yep.
Let's talk about that. Why? I can't even remember the details, but I just know I sold it to you.
Well, what put us back in touch? We got in touch because you called me probably 6 or 7 years ago about a listed with me a 6-unit property on College that you looked at. You didn't end up buying. It actually sold to an owner occupant. But it's the thing to do for a broker like me is to save the name and number of the guy like you that looks at stuff, right? Because I'm going to come across something else down the line, and now I have someone to bring that to. So your number was saved when you called. to try to buy the boarded up 2 unit.
Yeah, well, yeah.
You wanted to bulldoze it.
Yeah, because Marty Green, my property manager, said, "What are you going to do about that 2 unit next door to you? Because it's attracting the wrong element. It's abandoned. It's hurting our ability to rent out your units at the 4 unit." So yeah, I called you and I said, Mike, I see you just bought this.
I had just bought it for $36K cash. I ended up being able to buy the one on 5th Street roughly a year later, maybe sometime in 17.
Yeah, okay, the one on 5th Street, that's the 3 unit. I don't know if we talked too much about that. But
we haven't, but that was the second one I was able to get into, and that thing's okay, and I've got a unit there under complete gut rehab right now. Looking forward to getting that over with. Due to the refinance of one of these properties, now I had a lump sum of cash to work with again. By then I had some experience. I have a retirement account, but I wasn't going to put this money in the stock market or anything. I guess I'm thinking of myself as a boots on the ground guy, so I was going to go buy another piece of property. So I specifically came to you thinking, man, if he ever needs to sell that, it's a pretty good asset.
Yeah, and this is the 4 unit that I had owned right next to your 2 unit. It's
a pretty good asset that you bought cheap, in the downturn, and did the right things that you had to do at the time. Could we fairly call it like a B asset? It wasn't great, but it's certainly nothing wrong with it.
And what had been a C neighborhood, which was becoming more of a B neighborhood, especially evidenced by the fact that you would
people like me and others are throwing $100,000 investments down on boarded up 2 units.
Yeah.
So the tide was rising, so to speak. Some of the people that have coached me along the way have just said, I love having properties near each other. And I always had that in mind. And my thought was, once we became acquainted again, I was thinking, if Brian ever sells that thing, I got to be ready to buy it. So since I had that cash that I was going to deploy somewhere, I just came to you and said, hey, if you'd consider selling it, let's do it now. Although if you'd given me a hard no, I would have gone and bought something else. Right. And so paired together, I guess if I'm looking at that like a 6 unit now, which I sort of do, they have separate bills. And I really like that corner versus my 3 unit, for example. And if you look at the 2 unit plus the 4 unit and sort of average together the return and stuff, I really like it.
Now you, instead of having a 2 unit and a 4 unit, you kind of have a 6 unit on that corner.
Yeah, and in a way, it's possible. Let's say that things were reversed, and you came to me and said, "Hey, you're a broker. List this thing for me. Let me cash out of this one." It's possible that I might have paid you more than we might have got in the open market because I had the plus of having it might have been worth more to me because it was next to my best asset. Mm-hmm. And I know that I can, while I haven't had to do a ton to the 4 unit yet, I know I can get it out of there when the day comes when I got to sink some real money into it.
You were able to get it at a bit of a discount from me. Sure. Because as I remember it, how it worked was you called me and said, "Hey, do you want to sell your 4 unit?" And I said, "Well, I hadn't thought about it, but I would consider it." So I sent you my numbers. I said, "Here's my profit and loss statement for the past 3 years, current rent roll. You can see what we're making." Because you're a broker, you were able to pull comps. So we looked at comps of what similar properties it sold for recently. Correct. Also, you could value it on the income method as well. And we came up with a number that was slightly lower than what I could have sold it for on the open market. Sure. But since I didn't have to pay the cost of sale to, the real estate
I could
commission,
essentially waive them.
Yeah. So basically you built your real estate commission into the discount.
Sure.
And the way I made this decision was I looked at my walkaway profit after taxes, actually, of what I could make if I just sold it to you versus how many years would it take me to make that same profit in cash flow. And it was over 15 years.
Nice.
And that's how I made my decision. I'm like, so basically I can take 15 years of profits right now. And,
plus you've gotten into larger investments.
And then, move that money into something
and you
else.
know how to reallocate that.
Exactly. And
I hope to get to that point. Right?
But some of it's reallocation and some of it is just, paying the bills, keeping my kids in close.
Well, if a broker comes to you, which was me in that case, they have an obligation, a code of ethics that says they're going to at least help make known to you what that price might be like.
Yes.
If they were going to list it. So I couldn't not do that. I guess a bad person might try to convince you, what was our price? $275 or $280, something like that.
It was $275.
Okay, $275.
And I could have sold it on the open market for $300,
probably,
or
maybe
close. Maybe a little bit more. But
but you would have come close.
Had to pay the commission.
Yeah, your cost would have been more like 7.5% instead of, you probably paid a couple $1,000s in transfer taxes and title insurance.
Yeah, absolutely.
So that's a win. But a non-broker or a broker who's a terrible person, doesn't want to play by the rules, could come to you and try to convince you that was a 240 asset, right?
Yeah. That's why it
not
helps.
showing you comps, stuff like that. But since I was a broker, I had to, and I think I'm a decent person, so I didn't want to try to pull the wool over your eyes.
That's right. Well, part of it is relationships too. I mean, we always talk about building your network and having relationships with buyers and sellers out there. And since I knew you and we had a podcast conversation, and I'd had multiple conversations with you outside that, I trusted you.
Sure.
And I thought, well, I'd much rather sell it to you than put it on the open market and maybe get more, slightly more, I think, in my estimation.
Yeah. And set aside the fact that I'm a broker, just as a buyer of property, it's great for me to be in a conversation with a seller that nobody else knows is a potential deal. You know what I mean? I get a minute to look at this potential deal and say, okay, I like that or not. I don't have to try to beat somebody out. I don't have to act very quickly just to get into the deal. We both had adequate time to think about the deal.
Yeah.
So that's a plus, and that's relatively rare in the real estate market.
Yeah. Right? In fact, I think I had a timing issue, and I said, well, I can't, I don't want to sell it just right now.
Yeah.
And you waited a couple months for me.
Yeah, I think so.
If I recall. I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So how has that worked out for you, the 4-unit?
Pretty well as expected. I've been able to raise rents a little bit on 3 of the 4. There was some immediate turnover, so that rent went up, put in a new tenant at a higher rate. Now upstairs, you had a tenant expiring pretty much on closing date.
Yeah, I think we had a unit go vacant, right?
Yep. And for some reason, we couldn't connect with the guy. Neither, I guess, me or I don't know if you tried it or your property manager.
Well, was that the unit we put the wall heater in?
Yeah.
And he wasn't. It seemed like he wasn't
never there.
Even really living there.
Yeah. Yeah. I don't think he was physically there a lot. He just had to have a place, and it was convenient for him. None of us could track him down. Right after closing, I ended up tracking him down. But I said, well, I'm the new owner. I had checked out his credentials that you'd gotten. Be happy to have you continue. And he said, I just rented another place. Too bad, sort of a missed opportunity for both of us. Literally 6 minutes later, I got a Facebook message from an old friend from high school who was getting divorced and moving back from Florida. He knew I was a broker. He's like, hey, do you have any, sellers that just want to rent for a few months? I said, wow, your timing is odd because I just had an apartment that just opened up literally 6 minutes earlier. This is a guy I didn't need an application from. I've known him most of his life. I said, yeah, move in there for a few months. Here's the rent I want. Get back on your feet. And then, he owns some other assets and stuff and just sort of needed to pull a few things together, finish off the divorce and so forth. So he just needed a place to stay for a while. So I rented to him for 3-4 months. Then I put it on the market, and a former client of mine had said, hey, do you have any apartments? I got a buddy, kind of a thing. Okay. And so
sounds like word of mouth.
Word of mouth.
What's been filling your units.
Word of mouth did that. So also upstairs was that 2-bedroom, which was a couple. They worked in the service food industry. I think they were cooks, and they had a dog, and they were oddly very gracious and thankful towards me for letting them have that dog, which is ironic because it was you that let him have that dog.
Well, it was Green Property Management.
Yep.
We've been managing the property. I mean, we try to be dog friendly in as many properties as possible, or pet friendly, I should say.
And I'm rethinking that.
Are you?
Yeah. I think I'm small enough as an investor that I can find enough people to fill my units. Because with that one, so they were foodies, right? They worked in the industry. So they definitely cooked with some smells. Nice people. The place wasn't
cooking with smells.
Their spices were, whew. So they had that plus dog smells. So when they moved, I let them go. They wanted to be closer to work. It's like, cool. I knew I was going to have to do something in there, but I wasn't.
That's the one with the funky layout, right? It had like a weird kitchen.
It's got that patio upstairs, which is covered. You walk up the stairs outside.
Yeah, that had a strange,
walk right into the kitchen
layout. Yeah.
Yep. And then this huge kitchen, like you put a table in there or whatever. So I knew I was going to have to do something to it. So I just had the willingness to basically miss a month of rent. And I knew I was going to have a hard time showing it with that dog there and with them at work. So I just said, you know what, I'll move out, or I'll let them move out. I'll see what I got. I'll get the place cleaned up. If I want to invest some money in it, I'll make that decision at the time, and then and go forward at a higher rent rate. So the dog had an impact. I didn't replace any carpet, but we did. The carpet looked bad. We ran just a vacuum over it, and that really freshened it up. But it didn't quite lift the smells. So I went. This was a good purchase for like $120 at Home Depot. Got more like the carpet shampooer.
And that did the trick?
It did a whole lot more than I could have expected. It's the thing where you put a light detergent into this thing that looks like a vacuum but has a little water element, and you essentially vacuum very slowly, run it over the carpet, and it pulls stuff out of there. And we're talking beige carpet. I mean, you put that in around 2010. Everybody did beige carpet. The water coming out to the exit tank was black.
Oh my gosh! Wow.
And so that lifted a lot of, I think, it was essentially years and years of dog footprints. And it just freshened the place up. And I did the math on sort of tearing it all up and going to like a luxury vinyl plank floor. We're only talking like 500 square feet, so it's not a ton of product. And I think the reason I decided not to do that was that I'm the furthest thing from a contractor. I'm not particularly handy. And I thought I was just going to add time by, completely repainting the place and replacing the floors.
Right. Were you going to do that yourself?
Probably not, because I'm not any good at that stuff. So I thought, you know what? I'll lose another month to this if I do that.
Okay.
And I thought I could have done a pretty nice little spruce up rehab for $5,000 or less. But once cleaned up, again, you rehabbed this place not all that long ago, and it hadn't been destroyed. It was just, we'll call it suboptimal. Just cleaning it up. I mean, that rent went from, I think, $700 to $900.
That's fantastic.
Yeah.
So when we bought the property, and we bought this property back in 2009, it was vacant.
Yeah,
it was
probably
a vacant
a mess.
building. It was a mess. So our goal was to get it up to the standard of the neighborhood at the time. So when you say we rehabbed it or whatever, yes, we did, but it wasn't like
not high end.
High end. Right. It was a I don't know, medium grade type rehab. Which was meant to just kind of last us and get those medium income type rents. So kudos to you for pushing that rent even further.
Yeah, I think someday I'll sink some real money in there and try to go the next level. But even the stuff you did in 2010 is it's gonna work for a while. Yeah.
Well, and that's one of the things I wanted to kind of bring up about the sale, because that's a perfect property We bought it at a good price. We didn't have to put too much money. I think we probably put about $40,000 into it when we bought it. A lot of listeners tell me that they're interested in learning more about multifamily and apartment investing, but they just don't know where to start. Well, if you're looking for a comprehensive blueprint, then you should definitely check out Rod Cleef's Multifamily Bootcamp, happening May 1st through 3rd in Orlando, Florida. Rod personally teaches all 3 days, and you'll learn how to analyze and negotiate a deal, how to structure and fund your investment, build a team, and raise private money. You'll also learn how to develop a multimillionaire mindset, grow your network, and ultimately your lifetime cash flow. For more information, go to rodsbootcamp.com. You'll also receive a $100 discount by entering the code RPOA. By the way, it was foreclosure, 2009. We picked it up for under $25,000.
Oh, was it that cheap? I was going to guess. I had looked at some point. I was thinking it was 40. Well, remember, it had that piece of crap boarded up 2-unit next door all that time.
Yeah. The 2-unit next door was dragging down the value. But, there was a lot of that in that neighborhood at the time. The west side of Grand Rapids was not what it is today.
Yeah.
So we picked it up. We probably put, I want to say $40,000 into it. However, we knew from our property manager at the time that the previous owner had actually spent a lot of money to upgrade all the electric, had put a new flat roof on the building, still lost it in foreclosure, but they had invested a significant amount of money. What we had to do was put new windows in, repair the siding on the property, and then rehab a lot of the interior. But we all
beige.
Yeah. But what you did, so we get it up to a certain point, and we've got it rented out. It's cash flowing. And I went through the same thought process. I could spend more money now, because going into 2017, 2018, it's like, what do I want to do with this property? Do I want to invest more money into it to get those rents up $100, $200? Or do I want to put that money somewhere else?
Right.
Because now I'm investing in apartments at this point and other asset classes. So there's something I always refer to as fresh money. It's like in a way it's better to sell it to you so you can bring fresh money into it and take it to the next level, because your return on investment from doing it is going to be more and better than my return on investment of doing it. At least that's my perception.
And in a certain sense, where I'm at in my investing career, the ceiling is more like this type of property.
And you control that corner now too. So if zoning changes and you want to tear down both those properties, you could maybe build a 20-unit there because you've got the space.
And because of the time spent there, I've become acquainted with the property owner on the other side to the south. And we're talking, putting my broker hat back on, we're talking about potentially dealing with his decades-old portfolio, one of which sits next to my 2 best properties. So I'll probably end up owning that one too.
Yeah, there's
something. He knows I have an interest in it.
Yeah.
So
you're playing Monopoly now. I mean, you're controlling
the
board.
I'm trying to teach my 8-year-old the game Monopoly, and I'm making him really stick to the rules, because it's like, son, you can make a living at this one day. So,
well, good luck on that.
Yeah.
I want to switch gears.
Sure, let's do it.
And now you can put on your broker hat.
Sure,
because you're a associate broker at Berkshire Hathaway Home Services, which is new since the last time we talked. I mean, you weren't there.
I had my own brokerage. Let's see, that was middle of 2017. Yeah, I went back that fall. So I joined their management team in September of that year. Managed the downtown office, which, even though it was profitable, we still closed it. So now I'm kind of a broker at large with them. I have been for going on 2.5 years.
So you're out there, you've got your finger on the pulse of the market. I want to talk about the conversation you had with the owner of your gym.
Yeah.
And what he said, and which kind of is spurring the second part of our conversation today. But your gym owner, he was considering buying a house, it sounds like, but he's like, why the hell would I do that in the market today?
He was a skeptical tone. He said, why would I go out and spend $200,000 on a house right now just to have it lose $30,000 in the next couple of years? And he felt that way because he thinks we're going into a recession and it's going to be a repeat of 2008. That's what some people certainly think. And there's a lot of evidence to the contrary. Now, this guy's right around my age. He's early 40s. He's owned a house before, and I think that he got divorced. So the reason he doesn't own one now is that. But he was impacted, I would say, positively by the the Big Short, that event, right? In that he bought a house at the low point, and it was the marital status that changed him, not having that house, not anything else.
Not the economy,
right?
Or the Great Recession,
right? So he arguably benefited from that. But there is belief out there, and we as brokers get asked all the time about, what's coming up, what's going on in the market. None of us have the crystal ball, but the smart ones are following economists, following the housing experts that make the predictions. And so I have a colleague from another company, a guy by the name of Jim King. He manages an office for one of the larger brokers in town. In late August, he did sort of a Facebook infographic where he sourced a number of bits of information and made I would call like a public presentation just on social media of, here's answers to a bunch of the questions that the public is asking, that and brokers really enjoyed it because we're in these conversations all the time. And one of us took the time to pull together a bunch of data and make it very visual. And the most fascinating bit was looking at the last 5 recessions. This data is from CoreLogic National Home Price Index. The 1980 recession still had a 6.1% increase in real estate values that year.
Wait a minute. So you're saying during that 1981 recession,
1980, yep.
There was a 1980 recession. There was an increase,
6% increase
in value of
real
homes.
estate value. Yep.
Okay.
So let's carry on. There was another recession the following year, 1981, but it had a 3.5% increase. So real estate continued to go up in value during those 2 back-to-back recessions. By 91, so I was a teenager by then, there was a recession that had a 1.9% decrease. Think about that.
So home values went down on
2%.
average by 2%.
You and I, both real estate owners, could we weather 2% right now? Sure. We wouldn't even blink. So if there's a recession coming that has a 2% decrease in our real estate values, so what? It could impact something else. It could be, I have a IRA, which is worth, decent value. I'm glad to have that building so I can retire someday. Maybe that'll take a 20% hit. Who knows, right? It wouldn't be good, but so in 2001, I think we're talking really about the dot-com bubble. There was a recession there, came with a 6.6% increase in real estate values.
In 2001, real estate values went up on average 6.6%. Yep. And that's the 4th recession.
Fourth recession of my lifetime. Now, here comes the one that everybody remembers. 2008, a 19.7% decrease. Obviously, people remember that.
Yeah.
I was old enough, you were old enough by then that we were actually impacted by it. By and large, unless young people have studied real estate or are working in the profession or study economics or something, people under 35 now hardly remember this. Their parents were impacted, but they just weren't owning homes yet. And we're talking about people up to 35.
Yeah.
They just largely don't recall that phenomenon that we all experienced. I lost my butt on a Chicago property, that who knows what the percentage of loss on that deal was, but, you've mentioned yourself and some of these other investors, particularly around our town, started buying right after that and have done very well.
Yeah.
But this is what people remember and what they think of when somebody says recession.
And what they're judging the anticipated upcoming recession to look like.
Yep.
And yeah, I mean, I think you and I would both agree that what happened in the last recession is most likely not going to be what happens to real estate in the upcoming recession.
Correct. If your listeners have not seen the movie The Big Short or read the book, I actually recommend both. They should get out and do that. Those market conditions just aren't out there right now. People aren't. Yeah, there's talk that, okay, now you can go out and buy a house with very, very little down. That's a thing again. But you're not doing that with a 550 credit score, and you're not doing that 4 times.
Right.
You with a 700 credit score, you might be able to get into a property now for maybe 0 down, maybe 3% down on a conventional product versus a FHA. The government-backed loan products have a little bit more hair on them, I guess you could say. So that is occurring, but it's not happening for the subset of people. I mean, there's a group of people out there that just should not be buying a house. It's not for everybody.
No matter what the economy
Correct.
is.
Yep.
Yeah.
It's for a lot of people, but it's not for everybody. I don't really buy the American dream as owning a home. Mm-hmm. I consider it as it's a good thing for a lot of people, but it showed during that downturn that not everybody was suited for home ownership.
Right.
There even simple things like mobility. People buy a house and then 6 months later they take a job in Chicago. I've seen this happen. So here's what we're talking about. During my lifetime, which is I think barely shorter than your lifetime, 5 recessions. 3 of them, real estate increased in value. 1 of them lost 2% in value. Let's call it a wash, because we agree we could both weather that right now and without blinking. And everybody remembers the 5th one.
So a couple questions then. What is the average increase in home values on average?
Yeah, I can't cite this source offhand. I've seen it, but in specific to West Michigan, the 25-year running average is about 3.75% appreciation. If you think about it,
each year.
Yep. If you think about it, that would be great.
Yeah.
We can't sustain this double-digit increase stuff that we've been seeing here. Mm-hmm. We just can't. Our incomes, for the most part, aren't going up 10% a year. If that keeps happening, our buying power is shrinking dramatically.
Do you have data on how long it took from the last Great Recession where values did drop on average 19-20%?
Yep.
How long did it take for the values to get back to where they were?
Yeah. West Michigan itself recovered more quickly. Nationally, things didn't even bottom out until 2011, 2012. They started plummeting from 07 to 08 and just kind of stayed down and dipped a little more for those following years. And then just started to really rise dramatically. 2013 was great recovery. 2014 was even bigger. And things are continuing to appreciate, but it's starting to level, which is good. We need something more like 3.75, 3.5% appreciation, not 10. And it's not that real estate could never lose value again. It's likely to at some point, but the market conditions, particularly the lending market conditions that largely created 2008, they just aren't out there.
We're not seeing the bubble
right
aspect that we saw leading up to the Great Recession. And you could see that bubble forming because of the easy lending. And
I was working in Chicago at the time, and every modern new 2-bedroom condo with the latest finishes, which was stainless steel and granite countertops in 06, 07, they were all priced the same in all but the most premier neighborhoods. And it was largely driven by staying just beneath those jumbo loan limits. Mm-hmm. All these condos were $420,000. I had this little subset of young attorneys I had friends I grew up with that became attorneys. They would refer their attorney buddies, and all of them are buying as single people these $400,000 condos in these pretty good neighborhoods. A lot of times they were buying one and they were engaged to another attorney 6 months later who also had a $400,000 condo. And at the time I'm thinking about it, I'm like, this probably isn't good. 2006, 7, a lot of these clients were making good money, and I don't think got very hurt by this, but they must have not done well hanging on to these things through 2008, 2009, 10, when they had other life changes like marriages and stuff.
That's the thing where you saw a lot of overbuilding leading up to the Great Recession, a lot of like new subdivisions going in, new condos. And you're just not seeing that right now. I mean, because of the cost of construction and the lack of construction workers, you're just not seeing that type of overbuilding where that makes you say, whoa, they're building these too fast. And people are paying for them now, but that there's a bubble forming. You're just not seeing it. What is your outlook then? I mean, as a broker, what do you see for home buyers? I mean, we know that there's some sort of downturn coming. We don't know when it's going to happen, what asset bubble is going to pop, or what the black swan is that's going to make it happen. But give us your best shot.
Yeah, I think slow depreciation would be good. I'd like to look at my house or my 3 rental properties and be able to say, what if for the next 10 years I just got 3% appreciation on these things? Could they level off for a while? Sure. They're financially healthy enough that I'd be okay. I don't see the fundamentals out there for a big 20% dip. I just don't see it. When doing some of the prep to get together with you here and do this today, I actually did the math on that. I took what I own now as if I wasn't ever going to buy anything else. And I said, okay, if I took a 20% hit, am I okay? And thankfully, it looks fine. Sure, there are people that are over leveraged out there that if we had the 20% dip that I don't think is coming, would get hurt. But realistically, I just expect relatively low percentage continued appreciation, maybe some flattening, but nothing ugly. Owning real estate is the long game. You know that. I know that. I think people that are buying houses right now are safe. Interest rates are low. Every year, somebody comes out and says, well, rates are going up. This has been the message for the last 3 or 4 years.
For the last 18 years, I've been anticipating rates going up.
LOs are doing lots of refis. Affordability is still very reasonable.
Especially here in West Michigan. We're in West Michigan. So, if you're in San Francisco, it's a completely different story.
But people are moving with their feet, literally. They're in fact, the developer buddy on the drive over, he and I were talking about West Michigan. People are coming here. They're leaving. We don't so much get the San Francisco people, but we get the Chicago people. We get people from some of the cities in Ohio. We get people from Indianapolis moving here for things like our medical industry, education, things like that. So people are coming to Grand Rapids. To summarize that, the look backward at the 5 recessions of my 43-year-old life, the message is 3 of them were still positive for real estate. 1 was barely a blip. And then there was the one relatively catastrophic market shift that had that 20% dip that, again, I say that's not coming back anytime soon.
Okay.
I think a lot of the housing experts, the people that predict things, and groups like Mortgage Bankers Association, National Association of Realtors, Fannie Mae, Freddie Mac, they're all projecting relatively low percentage continued appreciation. And I tend to be on board with that.
Anyway, I want to thank you, Mike, for coming in. It's been fun talking about my old 4 unit.
Yeah.
I miss it and I want it back.
It's gonna be a big price tag on that. It's been a fun deal to do. Yep.
And you clean the carpet for me, so thank you. I'll appreciate that when I get it back. Thank you for your perspective on the market. Hopefully that informs us for the next recession or downturn, which we all know is going to happen, but we have no idea when.
Correct.
That is a podcast conversation that I recorded with Mike VanderWoude back in December of 2020, and that was before coronavirus really came on anybody's radar. So I brought Mike back. He's on the phone with me. Mike, welcome.
Hi, Brian. Thank you.
You gave us great data on the past 5 recessions, what happened, and how really the 2008 one was the worst for residential real estate. I'm wondering now, as we record this, it's Friday, the 13th of March, and basically the coronavirus is a black swan event that looks like it could tank our economy and send us into a recession.
Yeah.
What is that? What do you think that means for residential real estate?
So far, very little impact is showing, but there's a lot of discussion primarily amongst the participants, which on my playing field is licensed realtors working in the residential side of the business. I'm seeing 2 different themes. One of them is a little bit obvious, and it's who's doing open houses. People are pulling back on their open house activity, which might be smart. Let's come into fewer flesh pressing, handshaking activities as we can for a while. But I don't anticipate lack of open houses being very detrimental to real estate sales if we're talking about a 30, 60-day thing. There's a lot of other chatter amongst realtors about timing. So I'm looking at a Facebook post from a peer in the industry, and I'll just read it word for word. So if I list a 230,000 home in Forest Hills today, will buyer and buyer agents be out showing? And it's an interesting question. Forest Hills is one of our most demanded markets, and 230,000 is actually under the average price for the area. So this is a affordable home in a great school district. 45 other realtors weighed in on this private Facebook page. And it is overwhelmingly, yes, I'm going to be out showing homes to people. Basically, if that home is on our radar screen, we're going to be there. We're not going to hold back. And there was another agent that weighed in. Yeah, I listed a similar home, on, say, Wednesday. We're recording this on Friday, and this agent was saying, look, I got 15 showings on this thing for this weekend. Or here's another one where a agent is saying he has a listing in Wyoming at $165,000. Not a high price home in our market, but it has 20 showings and it has 3 offers. To me, that indicates no immediate impact. Where I see that there could be one, is maybe in the upper price brackets. If somebody has a $500,000, $700,000 home and they were going to list it soon, I can see that segment of the market holding back. Or similar example, I'm personally working with a retired dentist who's going to move here, and they were looking at a $350,000 downsize home, very nice home. They're retired, so their assets are tied up literally in retirement accounts. My own retirement account dropped about 25% over the last few days. I'm 43. I think I'll be okay. But I can see this retired dentist going, wow, I just lost for him maybe $250,000, maybe $500,000. And that was about what he was going to spend on a home. And I have not heard from that family about buying the house that they were very interested in. So if I had to boil all of that into one statement or opinion, I would say that at the lower to mid price points, I think activity is going to continue uninterrupted, business as usual. As we get into the upper price brackets, maybe, $400,000-$500,000 and higher, which in our market is essentially people of wealth, that group I think might stop and consider what they're doing.
What effect do you think that the incredibly low interest rates will have?
It will help us to not be interrupted with the momentum that is out there already. People do recognize those interest rates and see the opportunity that comes with them. I'm personally refinancing the 2-unit that has kicked off most of our conversations together, the one on Gunnison. And I'm about to have an investment property under 4% on a 15-year loan. So I think interest rates are definitely a positive influence in what's going on out there right now.
Well, thanks for coming back and sharing that anecdotal information with us. Your perspective from the ground is still pretty positive for residential real estate. I think this coronavirus is changing things day by day. So, here it is Friday. This episode comes out Monday. We'll see where we are then. But the fundamentals still are good. It sounds like people are still looking and agents are still showing. Mike, tell our listeners how they can get in touch with you if they would like to do so.
Yeah, if somebody wants to reach me, I recently opened a brokerage with some partners called Edison Brokers Co. My email address is mike@grar.com. My cell phone is area code 616-914-1556.
Let's hope everyone stays safe with the coronavirus. It is a serious thing, and we definitely take it seriously here on the show. Mike, thanks for coming back.
Thank you for having me, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Rod Cleef's Multifamily Boot Camp happening May 1st through 3rd in Orlando, Florida. Go to rodsbootcamp.com and use the code RPOA to save $100.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.